Buying a home is not just a financial but an emotional decision as well. In this video, we try to look at the financial part of it using an annual rental Excel based approach. Consider a 2 BHK house in Powai, Mumbai. This is actually the house that I live in. The rent is 50,000 per month. Annual it comes to 6 lakh and the value of the flat is 1.71 crores. The annual rental yield comes to 3.5%. Same has been considered in this model. Now the thought process that I'm going through is if I should keep on renting this house or should buy it with a loan tenure of 20 years. Following are the key assumptions that I've considered in this model. First, the down payment is 20%, which comes to 34.20 lakhs. The loan amount comes to 1.36 crores. Current interest rate is 8.5% on home loan. Tenure is 20 years. So the monthly EMI comes to 1,18,718. Now these are variable factors considering a period of 20 years. The property price escalation assumed is 7%, and this 7% will also translate in the increase in the annual lease rental. In the first year, say the rent is 50,000. In the second year, the rent will be 53,500 per month and the property price will move from 1.71 CR to 1.83 CR. Capital gains tax rate for long term in India is 12.5%. The property price after 20 years and 7% escalation comes at 6.61 crores. The rent tax benefit on the monthly rental paid is 20%. Interest benefit limit on home loan is 2 lakh. Inflation or discount rate is 6%, at which the net present value is calculated, and the return on investment is considered at 10%. Some further assumptions are the maintenance cost has not been considered because it is not a part of my rent. I have to consider it in actual, and I'll have to bear this cost irrespective of whether I'm buying or renting the property. Second is stamp duty. Now stamp duty is subjective from state to state and the time period of renting as well. Other factors that remain static for the 20 years are taxation loss and the rental yield. So as the property price is increasing, directly proportional to it, the rent amount is increasing. Also, the down payment amount, which is 34,20,000, is equivalent to the current savings. This means that the amount of down payment, 34.2 lakhs minus the security deposit for the rent, will be invested at today's rate. Okay. These are my rentals for the first year. A security deposit of 6 months, which is reflected over here, converts to 3 lakh. Property value of 1.71 CR and a rental yield, which is the annual rent divided by property value of 3.5 CR. Down payment is 20%, 34.2 lakhs, which is reflected over here. Loan amount of 1.368 CR with the interest rate of 8.5%, 20 years, paid monthly. The EMI comes to 1,18,718 using the PMT formula. Property price is escalating at 7% in the base case. Future value of the property after 20 years is 6.61 CR. Capital gain tax as per Indian income tax is 12.5%. The total tax, considering the property sold at the end of 20 years, for an apple to apple comparison, because For rentals, we'll not have any property at the end of 20 years. So the capital gains would be the future value minus current property value multiplied by capital gains tax rate, which comes to 61.33 lakhs. The value post-tax is 6 CR. Moving to the actual calculations. So the payments start with the down payment for EMI and security deposit for the rentals. The investment returns are calculated on the difference between the amounts paid for the buy option and the rent option. In the first year, the returns are only calculated on the amount which were available for the whole year, because it is not prudent to assume that the difference is invested immediately. So if we move to the second year, in the second year, the total difference between the EMI and the rental in the first year plus the investment returns in the first year, which will be compounded, are being considered. Same has been calculated till year 20, and the total investment returns, considering a return rate of 10% annually, comes to 3.84 CR. At the end of year 20, the property has been sold and the amount taken into account is the one minus the capital gain. In the case of rental cash flows, the amount on selling the investments plus the security deposit has been considered. The amount on investment returns has been considered after considering the capital gains. The total present value in both the options are as follows. This is how it looks. So first, talking about this number. What this value means is that if I buy the property and sell it after 20 years, it is beneficial by around 72,000 rupees. So buying is a better proposition in this case. However, one thing and another way to interpret this is whether this amount is sufficient to cover the cost of transaction of buying the property, which in this case is stamp duty and registration charges. So in Mumbai, the stamp duty is 6% of the total property value. So the amount in total comes to 6% into 1.71 CR, which is 10,26,000. The stamp duty to be paid on renting for 2 years is 6,000. So for almost a period of 20 years would be, say, because the rental amount will also increase. So even if I estimate it at 25, the difference is 8,76,000, which is higher than the benefit of buying in this case. So net and net, if I buy the property and then sell it, it is actually a loss for me by around 8 lakh rupees, the future value of which would be around 24 lakhs, 3 times this amount. Now, what if any of these factors change? While doing these calculations, the most important factors I could analyze are the rental yield and the property price escalation. One is something that will most probably in the ranges between 5 to 9%, and the rental yield almost throughout India is between 1.5% to 5.5%. So say for Gurgaon or in NCR, this moves somewhere between 2 to 2.5%, in Delhi between 3.5 to 4.5%, and in Bangalore from 3.5 or 4% to 5.5 or 6%. Now, first case, if the rental yield stands at 1.5%, no matter which case is taken, and even if the property price increased by 9%, there is just no benefit of buying the property. It is better to invest that amount and expect 10% returns from the market. Second case is when the rental yield is 2.5%. So in that case, obviously if the property price is escalated by 9%, then there is a major benefit on buying the property, else it is better to rent the property. Why does the property price escalation matters more? Is because the property price escalation is giving me overall 5, 6, 7, 8 or 9% return on this amount of 1.71 CR over the course of next 20 years. While in the case of renting, the amount that I've invested initially is just the difference between the down payment and the security deposit amount. On the other hand, if the rental yield, say in places like Mumbai and Bangalore, is 4.5%, in that case, if the property prices are increasing for more than 5%, which they are, it is better to buy the property. And if they increase by 7% or more, there is a major benefit.